Assalamu'alaikum warahmatullahi wabarakatuh. Hello everyone. Introduce us, we are from the Group 4 of Accounting Education Department in Universitas Negeri Yogyakarta. On this course, Intermediate Accounting 2, we will discuss about dilutive securities and earning per share. Introduce our group member, that is me, Ramadian Ade Kurniawan, and Lailatul Hikmah, Diah Ambar Puspitasari, and Olivia Ningrum. First, we talk about dilutive securities. Dilutive securities are securities that do not include ordinary share but can be converted into ordinary shares if the holder chooses the option. If converted effectively, dilutive securities will increase the number of shares outstanding, which can reduce earning per share. Based on PSAK 15, PSAK 53, and PSAK 55, the following are dilutive and compensatory securities are debt and equity, convertible debt, convertible share, stock warrant, accounting for share compensation. In debt and equity, much of the controversy relating to accounting for financial instruments such as stock option convertible securities prefer stock relates to whether companies should report this instrument as liability or as equity. In this meeting, we will find out how to tell the difference about instrument as liabilities or as equities. Convertible debt can be converted into shares in a predetermined period after issuance. Companies can do financing by providing a smaller proportion of ownership if the debt is converted, in addition to paying less interest for similar types of debt. In debt conversion, and there are two main reasons why companies issue convertible debt. First, the desire to increase capital without exercising excessive control and obtain common stock financing at a lower price. Convertible account payable implementation of the with and without approach. The first, determine the fair value of debt that can be converted into liability and equity component. Second, determine the liability component by calculating the net present value of future cash flows at market interest rate. And last, remove the liability component from the fair value of debt which can be converted to obtain the equity component. For example, the illustration with the APC issues 1,000 convertible bonds with a fair value of 200,000 rupiah in early 2013. The bonds have a period of 6 years with interest payment of 7% at the end of December. Each bonds can be converted into 100 shares with a fair value of 500 rupiah. The market interest rate for similar bonds is 9%. The liability component of the bond when issued at fair value is, we have to find out the present value of the liability component. It obtained from present value of principal plus present value of interest payment. 200,000 million rupiah is from convertible bonds times per value. We get 119 million rupiah in present value of principal, and the 14,000 million rupiah we get from 7% from 200,000 million rupiah, and we get present value of interest payment 62 million. The present value of liability component is from present value of principal and present value of interest payment, and we get 182,056,325. The equity component of the bonds when issue at fair value. Fair value of equity component at issuance dates we get from fair value of convertible debt at date of issuance less the fair value of the liability component at the date of issuance, and we get 17,943,675 rupiah at fair value of equity component at issuance date. Journal entry, we debit cash amount to 200,000 million rupiah, and we credit bonds payable amount 182,056,325, and we credit share premium conversion equitas amount 17,943,675 rupiah. In convertible debt, in condition 1, bonds are not converted to maturity. So we journal entry debit bonds payable amount 200,000 million rupiah, and then we credit cash to 200,000 million rupiah. And in condition 2, bonds convert at maturity. The journal entry is we debit share premium and conversion equity amount 17,943,675 rupiah, and we debit bonds payable to 200,000 million rupiah, and we credit share capital ordinary and share premium ordinary. Share premium conversion equity account amount 17,943,675 rupiah was transferred to share premium ordinary account. Share capital ordinary we get from 1,000 convertible bonds convert into share 100 with a par value 5,500 rupiah. So we get 50,000 million rupiah. In condition 3, bonds are converted before maturity. For example, bonds were converted into share on December 31, 2015. So it's 3 years after issuing bonds. This is a bond amortization list. Discount amortize is from interest expense minus cash paid, and the amortized discount will be added to carrying amount of bonds. In the end of year 2015, we get 189,874,821. In the journal entry, we debit share premium conversion equity amount 17,943,675, and we debit bonds payable amount like carrying amount of bonds on table. And then we share capital ordinary amount 50,000 rupiah, 50,000 million rupiah. Share premium ordinary amount 157,818,496 rupiah.
Okay, the next material will be presenting by me, Olivia Puspita Ningrum, number 27. The next slide is induced conversions. An induced conversion is a transaction which a reporting entity offers additional shares or other consideration, or we usually call them sweeteners to investor to incentivize them to convert their convertible instrument. The purpose of induced conversion is to reduce interest expense and second to reduce ratio debt to equity. For the example, PTDF issues convertible bonds with par value of 500 million, which can be converted into 200,000 shares of ordinary shares with par value of 1,500 and records their premium equity conversion of 70 million. 2 years later, PTDF wants to reduce the interest expense by providing incentive to the bondholders of IDR 85 million for converting their bonds. So, when the conversion occurs, PTDF records the following. In debit conversion fee is 15 million. In debit share premium convertible equity is 70 million. And in debit debt bond is 500 million. And in credit common stock is 300 million. And in credit common stock premium is 500 million and cash is 85 million. Okay, the next slide is convertible preferred stock. Convertible preferred stock are preferred shares that include an option for the holder to convert the shares into a fixed number of common shares after a predetermined date. Most of convertible preferred stocks is exchanged at the request of shareholders, but sometimes there is a provision that allows the company or issuer to force the conversions. The value of convertible preferred stocks is based on the performance of common stocks. Convertible preferred stocks is an equity unless it is a redeemable preferred stocks. And conversion or repurchase is based on book value, no loss or gain is recognized. And any excess paid over book value is often debited from retained earnings. And the next slide is warrant. Share warrants are the granting of rights to be holders to buy shares at a certain price and certain period. Usually, warrants are issued together with the issuance or sale of bonds. Warrants are used by companies with less potential to issue shares in order to sell bonds. So, from that, warrants are referred as a sweeteners in bond issuance. Warrant it become a common stock, sometimes have a dilution effect by reducing the EPS amount. There is three situations for issuing warrant. The first situation is to make the securities more attractive. The second is grant preemptive right to shareholders. And the third is compensation to employees. Okay, the first situation is share warrant issued with other securities. When issuing various types of securities, such as bond of preferred stock, company often include warrants to make the security more attractive. This first situation, warrant is mostly a long-term option. The with and without method is used to allocate components to warrant issues with other securities. If the investor does not exercise the warrants until after that period, the equity component that are share premium account warrants is debited to the paid premium account expired warrants, which are the rights of the original shareholders. Okay, the second situation is if the right to purchase additional shares upon issuance of new shares proportionally. The second situation is to prevent dilution or of voting rights. And the second situation is a short-term option. In the first situation is long-term, but in the second situation, warrant is a short-term option. The company only makes a memorandum entry when issuing warrant to shareholders, and if the company receives cash that is greater than the par value of the shares, it is credited to the paid in stock, ordinary account, and otherwise. Okay, and the third situation is warrant share buying rates for executive and employee. The third situation is warrant is a long-term. Long-term compensation, the aim is to increase the employee loyalty. Stock option reporting method, there are two methods. First is intrinsic value method. The first method is have difference between the stock price and the price at which the warrants were exercised when the warrants were issued. And the second method is fair value method. The value at which an asset can be exchanged or a liability settled between parties who understand and are willing to enter into an arm's length transaction. Okay, the next material is accounting for share compensation. Accounting for share compensation is a way to paying employee, executive, and directors of a company with equity in the business. This is typically used to motivate employee, executive, or directors beyond their regular case-based compensation like salary or bonus, and to align their interests with the company shareholders. In accounting for share compensation, there are determining compensation expense using the fair value method and allocating compensation expense during the period the employee works. For the example, PT ABC plans to compensate 10 members of the board director for buying 1,000 shares each with a par value of 600, yes, of 600. The option were granted on January 1, 2012 and can be used for the next 6 years. The option price per share is 200 and the market price of the stock is 300 per shares. The fair value of compensation expense is 16 million and the estimated period of service is 2 years. Okay. In 1st January 2012, there are no record and option granted. After that, in December 31, 2012 and 31 December 2013, there are recording of compensation expense. In debited compensation expense, the amount is 8 million, and the credited is share premium option, the amount is 8 million. After that, the recording when the board of directors exercise 40% option rights, there are 4,000 shares on February 25, 2015. In debit cash, the amount is 8 million. And in debit share premium option, the amount is 6 million and 400,000. And in credit is common stock with 2 million and 400,000, and share premium ordinary is 12 million. So the next is recording when the board of directors does not exercise the option right until the expiration. It is 6 years. In 1st January 2018, in debited is share premium option. The nominal is 9 million and 600,000, and the credit share premium option expired. The nominal is 9 million and 600,000. Based on IFRS, the company does not make adjustment to the compensation expense at the expiration date. The company can make adjustment if there are service conditions in the compensation plan. And because the market conditions are reflected in the determinant of the fair value of the option at the grant date, no adjustment are allowed if the cause in change in the company's share price. Okay, the next slide is restricted shares. The company provides shares to employee on the condition that the shares cannot be sold, transferred, or pledged until certain conditions are met. If it's violated, it must be redeemed along with the dividend that have been received. The advantage of bond shares over stock option is first, it will not be useless regardless of the stock price in the market. The second is provide less equity reduction to shareholders. And the third is aligning employee goals with company goals. Okay, the next slide is employee shares purchase plan. The company gives employee the opportunity to buy shares at a discount for a certain period of time. This plan is a compensation program and should be recorded as an expense over the period of service. And the next is compensation plan disclosure. The compensation plan disclosure to ensure user of financial statement understand about first, the nature and the extent of the share-based payment assignment that occurred during the period. Second, how to determine fair value for good service received or equity instrument granted. And the third is to know the impact of share-based payment transaction on profit or loss on the company financial position. Okay, there are for me. Thank you.
And the next material will be presenting by me, Lailatul Hikmah, and we are going to discuss about earnings per share. So in computing earnings per share, we have two topics. There is simple structure and complex structure for earnings per share. So what is earnings per share? Earnings per share show the profit earned by each share of common stock or ordinary share, and companies report earnings per share only for ordinary shares, not for preferred share. And when the income statement contains intermediate income components, the company must present the earnings per share for each component. And when the income statement contains discontinuous operations, companies are required to report earnings per share from continuing operations and net income on the face of the income statement. And then earnings per share for a simple capital structure. In simple structure, the earning per share only for ordinary shares, no dilutive securities and no potentially ordinary shares upon conversion or exercise. And simple structure cannot be another share. And the complex structure, there are dilutive securities, or it means in the complex structure includes securities that could have a dilutive effects on earnings per ordinary shares. And dilutive means the ability to influence earning per share in downward direction and decrease earning per share as a divisor increase. And we have to remember that in earning per share there are three concepts. There is a simple structure, complex structure, and dilutive structure. Considering that there is a conversion to liabilities to equities where the denominator is so many, earning per share will be cast down. And then the comparison between simple earning per share and diluted earning per share. The earning per share is net income minus by preferred dividends and divided by weighted average shares outstanding. There is 4 basic earning per shares. And for diluted earning per share, we have net income minus preferred dividends and then divided by weighted average share outstanding and minus impact of convertibles and minus impact of options, warrants, and other dilutive securities. And the company's capital structure is said to be simple if there is only ordinary share or no ordinary share that has the potential to reduce the earning per share of ordinary share. And the company's capital structure is said to be complex if including securities that could result in a reduction in the earning per share of ordinary share. And the subtract the current year preference share dividend from net income to arrive at income available to ordinary shareholders. And the basic of earning per share shall be calculated by net income minus preferred dividends and then divided by weighted average number of share outstanding during the period. So every ordinary share profit has the right to get the share of earning per share in the amount obtained from the calculation results. However, it is not what is distributed to shareholders. It still has to be determined at the general meeting of shareholders. And the earnings per share for simple capital structure, we have when preferred stock dividends include one is the amount of dividends from preferred shares declared for the period concerned, and the second is the cumulative preferred dividend amount accumulated for the period concerned, whether the dividend has been declared or not. And the last is the cumulative preferred stock dividend amount for the period does not include the previous period's cumulative main share dividend even if the dividend was declared or paid in the current period. And if a company declares a dividend on preferred stocks when a net loss occurs, the preferred stock dividend is added to the net loss component to calculate the loss per share. And then next, weighted average number of shares outstanding. The company must weigh the number of shares outstanding based on the fraction of the period in which these shares were outstanding. And when share dividends or shares sold occur, companies need to restate the share outstanding before the share dividend or split. And the weighted average number of ordinary shares outstanding is multiplies the number of shares outstanding during a certain period of time weighted factor. And time weighting factor is the number of days outstanding for a group of shares compared to the number of days in a period. And then ordinary shares are considered outstanding shares is when first ordinary share issue in exchange for cash are included when cash receivable. 2. Ordinary share issue on the voluntary reinvestment of dividends on ordinary or preference share are included when dividends are reinvested. And 3. Ordinary share issue as a result of the conversion of a debt instrument to ordinary share are included from the date that interest caused to accrue. An ordinary share issue in place of interest or principal on other financial instruments are included from the date that interest to accrue. And the ordinary share are considered outstanding share is ordinary share issue in exchange for the settlement of a liability of the entity are included from the settlement date. And ordinary share issue as consideration for the acquisition of an asset other than cash are included as of the date on which the acquisition is recognized. And the last is ordinary share issue for the rendering of service to the entity are included as service are rendered. And if during a period there is a change in the number of shares outstanding, that does not change research. Other than the conversions of potential ordinary share, the weighted average number of ordinary shares outstanding during the period and for the entire period present must be adjusted. And stock dividends and stock split are considered to have been outstanding since the beginning of the year, so adjustments are needed for previous stock transactions. And the stock dividends or stock split that occur after the end of the year but before the company issue financial statements are still adjusted for the year and the previous year if there is comparative information. So this is the example of weighted average number of shares. In January 1, 2013, the beginning balance is 60,000. In January 2, 2013, issue 36,000 share of cash and then purchase 24,000 share and then stock split 2 for 1, 72,000 additional shares, and then issue 12,000 share for cash, and then issue 10,000 share for cash, and the ending balance is 166,000, and the 166,000 is weighted average number of shares outstanding. And then next, this is the example of weighted average number of shares. This is the date outstanding is 1 January until 1 February. The share outstanding is 60,000 and the restatement is 2, and the fraction of year is 1/12, and weighted share is the A multiplied B multiplied C, and we have 10,000. And in 1 February until 1 April is share outstanding is 96,000 and restatement is 2. The fraction of year is 2/12, and then the weighted shares is 32,000. And the end is weighted average number of shares outstanding is 154,000. And the next material, we are going to discuss about earnings per share for a complex capital structure. In complex capital structure exists when a business has first convertible securities, and second is has options, warrants, or other rights that upon conversions are exercised called diluted earnings per share. And the company reports both basic and diluted earnings per share. The diluted EPS includes the effect of all potential dilutive ordinary shares that were outstanding during the period. Companies will not report diluted earning per share if the securities in their capital structure are anti-dilutive. And convertible securities. In the convertible securities, we have 1. The conversions at the beginning of the period or at the time of issuance of the securities if issued during the period, and the elimination of related interest or net of tax. Therefore, the conversion of securities will cause an increase in the denominator, it is weighted average shares outstanding, and will increase the numerator, that is net income. And if the conversion rate changes during the period the securities are outstanding, the company uses the conversion rate that reduces the proportion of equity. And in earnings per share for complex capital structure, there have two topics. This is net income adjustment for after tax and adjustment of ordinary shares outstanding. In the net income adjustment after tax, the first is dividends from dilutive potential ordinary shares, and then interest on potential dilutive ordinary shares recognized in the period, and the last is changes in income or expenses from the conversion of dilutive potential ordinary shares. And in the adjustment of ordinary share outstanding is plus the weighted average number of shares to be issued, assuming all potential ordinary shares are converted into ordinary shares. And The conversion is assumed to occur at the beginning of the period or on the issuance date of the potential ordinary shares if the issuance is later. And this is the example of earnings per share for complex capital structure. The illustration is PT STB has net income of 15 million for the year and weighted average number of ordinary shares outstanding during the period of 1 million shares. The company has 2 convertible debenture bond issues outstanding. One is 8% issue sold at 200, total is 60 million in a prior year and convertible into 200,000 ordinary shares. Interest expense for the current year related to the liability component of this convertible bond is 5 million. And the other is a 7% issue sold at 100. The total is 40 million on April 1 of the current year and convertible into 90,000 ordinary shares. Interest expense for the current year related to the liability component of this convertible bond is 5 million. The tax rate is 25%. And this is the calculation of the illustration. Because the company issues as 7% convertible debenture next to the beginning of the year, it will charge shares. In other words, the shares are considered outstanding from April 1 until the end of the year. As a result, the interest adjustment for the numerator of this bond reflects interest that only counts for 9 months. Thus, the interest added to the 7% conversion debenture is 750,000. And the 54 million and 500,000 showing adjusted net income. This amount becomes the numerator of the calculation for diluted earnings per share. The company then calculates the weighted average number of shares outstanding. The number of shares is the denominator in the calculation of diluted earnings per share. The weighted average share adjusted for dilutive securities is 1,230,000 rupiah. And on the income statement, the company reports earnings per share and diluted. And this is the income statement of the company. Net income 50 million. Basic of earning per share 15, and dilutional earning per share 44.31. And in the diluted earning per share, options and warrants, the measure the dilutive effects of potential conversion using the treasury share method. The method assumes that 1. Company exercise the options of warrants at the beginning of the year or date of issue if later. And the last is that is use this process to purchase ordinary shares for the treasury. And the next is anti-dilutive securities. In anti-dilutive securities, the first is in calculating earning per shares, companies need to separate securities that are individually truly dilutive from those that are anti-dilutive. Second, potential ordinary shares are considered dilutive if they reduce earnings per share from continuing normal operations. And next, to determine the dilutive effects, net income from normal operations is used minus preferred stock dividends, or discontinued operations are issued. And the potential ordinary shares are anti-dilutive if they increase earning per share from continuing normal operations or decrease loss per share from continuing normal operations. And the companies must issue anti-dilutive securities and must not use them to cover dilutive securities. And that can be converted into anti-dilutive if the additional percentage of income from interest expense after tax is greater than the additional percentage of shares if that is converted. An option or warrant becomes anti-dilutive if the exercise price of the option or warrant is greater than the market price. And the last is anti-dilutive securities. If in determining whether a potential share security has a dilutive or anti-dilutive effect, each issue must be considered separately, not in aggregate or as a whole. And the other in which the potential ordinary shares are considered can affect the decisions whether the securities are classified as dilutive or not. And the last is to maximize the dilution of the basic of earning per share. Each issue or series of share issuance should be considered in order from the most dilutive to the less dilutive. And this is the reference of the material. And that's all from our presentations. Thank you for your attention and thank you for watching our presentation video. Wassalamu'alaikum warahmatullahi wabarakatuh. And don't forget to like and comment this video. And see you.